Assets and liabilities are fundamental concepts of financial accounting that provide crucial information about the financial health of an individual, business, or organization. Understanding the difference between assets and liabilities is essential for financial analysis, investment decision-making, risk management, and overall financial management. It helps individuals and organizations assess their financial position, determine their ability to meet financial obligations, and make informed choices about allocating resources and managing debts. In this video, we'll delve into the world of finance and explore the difference between assets and liabilities, providing you with the knowledge necessary to make sound financial decisions and achieve financial stability.
By the way, if you like this type of content, be sure to hit the like and subscribe button.
What are assets? Assets are resources owned or controlled by an individual, business, or organization that hold economic value. They can be acquired through purchase, investment, or production. Some assets can appreciate or depreciate in value over time and may require maintenance or upkeep to preserve their worth. Current assets versus fixed assets. Current assets are short-term assets that are expected to be converted into cash or used up within a company's operating cycle, typically within 1 year. They are important for a company's liquidity, as they can be easily converted into cash to cover short-term obligations like salaries, rent, and utilities. Common examples of current assets include cash and cash equivalents, accounts receivable, inventory, and short-term investments. Fixed assets, on the other hand, are long-term assets used to generate revenue or provide services over a longer period and are not intended for resale. These assets are more expensive and require a significant investment of resources to acquire and maintain. Some examples of fixed assets include land, buildings, machinery, vehicles, and furniture. Tangible assets versus intangible assets. Tangible assets are physical assets that have a physical form and can be touched, seen, or measured. These assets hold intrinsic value and can be bought, sold, or used in business operations, such as real estate, equipment, vehicles, inventory, and cash. On the contrary, intangible assets lack physical presence but hold significant value to a business. These non-physical assets are characterized by legal or intellectual property rights and often used to generate future benefits. Intellectual property, software, licenses, and contracts are some common examples of intangible assets. What are liabilities? Liabilities are obligations or debts that an individual, organization, or entity owes to others. They represent the claims or demands on assets that must be fulfilled in the future. Liabilities arise from past transactions or events and require the transfer of economic resources or the provision of goods or services to settle obligations. Liabilities can take various forms and originate from different sources, which may include amounts owed to suppliers for goods or services received, loans or borrowings from financial institutions, unpaid taxes, employee wages and benefits, lease or rental obligations, and more. Short-term liabilities versus long-term liabilities. Short-term liabilities, also known as current liabilities, are obligations that are expected to be settled within 1 year or within the normal operating cycle of a business. These liabilities typically require the use of current assets or the creation of new current liabilities to cover the repayment. In comparison, long-term liabilities, also referred to as non-current liabilities, involve obligations with repayment terms extending beyond 1 year and are usually financed through long-term financing arrangements. Assets versus liabilities. Assets are resources or possessions owned or controlled by an individual, organization, or entity that have economic value and can generate future benefits. Liabilities, however, are obligations or debts that an individual, organization, or entity owes to external parties. Assets and liabilities are reported on a balance sheet, which provides a snapshot of an entity's financial position at a specific point in time. The balance sheet follows the equation, assets equals liabilities plus equity. Equity is the residual interest in the assets of an individual, organization, or entity after deducting liabilities. In other words, it represents what would be left for the owners or shareholders if all the debts and obligations were settled. Assets are indicators of an individual's or organization's financial well-being and potential for future growth. Having valuable assets contributes to financial stability and opens up opportunities. Liabilities signify the financial commitments that must be met. Effective management and control of liabilities are vital to preserve financial health and prevent excessive debt.
If you want to see more of these videos, please leave a like and subscribe to our channel. Also, be sure to leave a comment. We appreciate all comments and feedback from you.
Thank you so much.
That's more than enough to help us grow and sustain our production expenses. See you in our next video.